All right, good evening, guys. Ken at Tortoise Capital. This is the nightly strategy podcast for Friday, May 6th, 2022. Screen share and mic check, please. Okay, good. So, this is the overview of the release of the Creativity 202 bundle that just went over to VTI today. It just got released. It's going out to the super traders first on a special deal. There's 3 courses in that bundle. Creativity 202, which is the Fletcher treatment for traders. That's a big, powerful course. Creativity 101 is the short form of the introduction to creativity that I provide to Army leaders to prepare them for Creativity 202. Resilience 101 is a home study course that, won't hurt you. We could all use a little resilience in these troubling times, and it's how to build up that emotional bank account, how to just deal with things, how to grind. So the Creativity 202 course combines 2 very powerful bodies of knowledge: the creativity science of Dr. Angus Fletcher and the true storytelling literature of my doctoral mentor, Dr. David Boji, who for 40 years has been the world's leading scholar in the field of organizational storytelling. In fact, he created it back in the about 40 years ago, is still the most widely cited academic scholar. And he's done an amazing amount of work with indigenous ways of knowing, deep listening, ensemble leadership, non-Western ways of sense-making. And he's taken me on as a postdoc researcher for the True Storytelling Institute, where I've taken all their courses and whatnot. So we're going to incorporate insights from storytelling and literature from both of these 2 leading scholars in the world: the creativity science of Angus Fletcher and the true storytelling of Dr. David Boji. We're going to use the true storytelling techniques and frame of reference to create very powerful collaborative learning spaces when we do the weekly debriefings of the 30 lessons that are found in Fletcher's work. So there's 30 lessons that Fletcher wrote up in his handbook, in his field guide to creativity for Army leaders. It features about a half a page of reading and then 1 or 2 experiential reflection learning exercises that ask you to go into your experience and try to imagine things in a new way according to one of the 30 principles that are in that book and which are taught in each of the individual lessons. What I then do is take 1 or 2 trader exercises that are connected in some way to the principle that is in the Fletcher exercise. And it asks you to go deeper into your own trading or to think about a trading problem or opportunity in a new way. And in that way, we're going to bounce these 2 bodies of knowledge off each other. We're going to ask you to keep in mind a personal work in progress so that as you smack these 2 stones together and make sparks, we think that there's a good probability of getting some kind of creative insight into the work in progress that you're working on as in juxtaposition to those 2 bodies of knowledge. And then we're going to ask you to develop through personal reflection a short 2 to 3 minute true story about the aha moment that you experience and what it means to you at an emotionally significant level, what that breakthrough is like when you feel that. We're going to ask you to write about that in your learning journal, and that's what the course is about. Now, we're also going to try something new, which is a voluntary invitation to collaborative office hours each week, in which the people who take that course, that would, if they would like to, will get together and we will run a true storytelling circle with a sacred story space under my hosting in which we are going to go through a process of sharing those stories in a true story circle, a sacred story space. And in that circle, your only job is to tell your story as best you can, as truthfully you can, as honestly as you can, and empty your bowl in 2 to 3 minutes about what you learned that week. Everybody else's job in that circle is to simply experience deep listening without judgment, processing, advice, computation, anything, just to stop, sit still, and let things be as they are. For that 1 hour, all we want to do is practice telling the truth, listening to the truth, feeling what it's like to be in the presence of the truth, and let that story, which was told in that way for the first time ever, because each story as it's told is new and unique, we just want to let that story get its legs and let it go off into the world to be what it is, without judgment. What happens after about 2 or 3 experiences like that, you get really, really hungry for the truth. And pretty soon, nothing else will do. You will insist on being truthful and hearing truth in others, and you'll get used to hearing yourself telling your truth to other people in public and realize that that's really an empowering thing. And you'll be listening to the amazing stories of other folks, and you bring your gift and you offer it to the group, and your bowl is empty, and then suddenly all these other true stories come in, and they're so powerful, it just resonates through you from top to bottom and back up. And because we're not doing any processing or advising or estimating or waiting for our turn to speak, and just, we're just engaged in deep listening. And in that sacred space, that is unbelievably powerful. When the stories are told, we ring the bell and move into the foyer, in which we have now a chance to talk about whatever is on our mind in coffee talk and respectful dialogue. And when that part of the circle is over and we go back out into the world, then there's always plenty of opportunity for the opportunities to collaborate and do whatever else you're going to do. Having just experienced safety, trust, and truth, opportunity naturally follows. So each week of those 30 lessons, what we're going to do is work hard on our own in our work in progress and try to apply those principles of creativity and introspection, and try to discover something interesting and amazing to share with our partners in the collaborations. And we're going to do that every week. And so you're invited to come as often as you wish or as little as you wish. There's actually no pressure to talk. The only thing you got to do is respect the agreements that we are not going to judge each other, advise each other, process each other, give opinions. We're just going to let people tell their own stories, and we are only going to tell our own stories. So it's only your own personal testimony from your lived experience. This is an amazingly powerful process. I've gone through about 300 of these as a host in 4 different learning environments, with my soccer team, with business consultants, with military officers, and with a hand-picked group of traders that get together every Saturday morning and talk about these things for like this for about 90 minutes. And it's just off the chart good. Then after those 30 lessons are through, we'll be out around somewhere around Thanksgiving, I suppose. We'll do a wrap up, and then we'll figure out if we want to do more as members of that group, and we can see what comes after that. So that's what a quick overview of the Creativity 202 workshop is like. It is unlike any other workshop you've ever taken. And the beauty is that you don't have to master all 30 lessons and somehow put all that together and become creative. No, each one of those little lessons is like a key to a door that could open up the surprise package, and suddenly the aha moment just occurs. So any one of those could be the thing that really makes the life-changing difference, all in addition to just the experience of living in the truth often does it by itself. So that's what we think that's going to be like. And I will just tell you that the sniper trading, that we've just published and are getting ready to release out to the world came from one of those collaborative learning experiences. The whole idea of how we are streamlining the search for critical states based on location and volatility came out of a creativity exercise and a true storytelling circle reflection. The trade this morning, the sniper trade on the right, which I'm going to cover a little bit later, which returned about 7R and EWZ, was the visual box trading that trade will employ, was a consequence of a Creativity 202 collaboration session. On the left-hand side, Luis sent me a note last night he had a creative instinct about something that might be done with the volatility stats on 1 minute bars intraday, and I've turned that into some pseudocode that I got my son, the data scientist, working on, and Danny to add to the TC2000 bundle. I agree that I think there's something really important in there that will give us a way to operationalize a training strategy that I call the snapping turtle, which waits for an unusually large intra-bar move that alerts us to something unusual going on. More to follow on that one. That's going to be a work in progress, and all of those come out of the Creativity 202 sensibility. In fact, the entire interning program and the trader's journey that these guys are going through, like Phil and Nick, comes from a restorying of the trader's individual journey into one of a heroic journey that is mutually supported. And so we've built out a storyline of what it should feel like when you're going through our trading process in the direction of creating and solidifying your own niche as a trader, and then developing the ability to articulate it, to teach it, to coach it as a way of learning your own material better. And that came out of a Creativity 202 experience. And Tim's wonderful debriefing of his first couple hundred trades takes the form of a true storytelling report that just kind of reveals what's going on and gives us a frame of reference for understanding his work. The reflective learning journal template that the interns are using came from a Creativity 202 discussion about what kind of process could we apply to standardize and normalize and improve our routine reflective learning. The stories that Phil and Tim wrote to themselves about their first couple months worth of learning are masterful insights into what it is like to be them living through the process in a public space that is safe, trusted, and truthful. And they're starting to see the opportunities that are arising when you bring together people of goodwill that are genuinely committed to the mutual support, and so that the people may thrive. Once you get used to that way of working and living and being, nothing else will do. I've noticed that in all of my collaborations that employ true storytelling. So I wanted to give you a feel for that. There's another video where I just described what I just said, but I think this one was better because the other one was unrehearsed. This one I had a chance to think about it a little bit more, but I wanted to give you a chance to experience that. All right, I want to just take a quick look. Oh, I guess I need to. Let's go right to the reports. Get that knocked out. Review shapes rectangle. So here we are for May 7th. We remain in bearish volatile, still getting smashed on the longer term, and the short term is still troublesome. Risk Z is giving us a warning that we are at these um, abnormal volatility stat locations. This can lead to, if the market heals, an amazing swing trade just like this one and this one. But it can also lead to an additional painful experience to the downside, which is not to be ignored. Theoretical exposure in ETF2 remains at 0%. That has been a remarkable week to week asset allocation tool that has been a very good protector of capital for longer term traders. On the monthly market health check, what I've done is I'm exploring a simpler presentation of that for a change using the standard layout of the sniper trading, where, as you can see, we've cleaned up a lot of the extra indicators. We've added back in a visual on the MACD histogram and on a Williams percent R10 in the same way that we do with the WMB3. We've included the RL10 as the trader's price for that time frame, and simply the dragon and the PSAR, and that's it. And I think it will make it a little bit easier to see some of the primary patterns, like when the RL10 and price is on the north side of the dragon and then goes through a transition process and crosses to the downside. That's a significant moment in market psychology and in price action that we want to be mindful of. This would be the trigger for a downside trade from around this price level here at about 430, which is a 30-point move. That's almost an 8% further sell-off that could have been triggered by paying attention to that little crossing point on the monthly. The 9-day is a little closer zoom in, so it's like every 2 weeks, and you can see what is really interesting about this is the fact that you get a collapsing dragon clearly established right around, say, 433 from this high, a lower high. The crossing of the dragon and the PSAR dot here on the 9-day gives you a nice protective stop around 455. You might have also had it here around 452, and certainly everything to the right of that price action looks a lot different than all the prices on this side when everything is fat, dumb, and happy as it moves up the stack. So you can see that the simplified version, even on the 9-day, gives you powerful insights into longer-term position trading. The weekly is also showing that nice consolidation, and then the Kata 2 roll over to the downside. This is where the Kata 2 would trigger. You could also get the PSAR trigger here and the collapsing dragon at around 425. So you can see, even on a weekly basis, there was a real strong opportunity to have a swing position to the short side. We'll notice that we are significantly oversold. We don't have an uptick yet, so we're going to watch that just to see if the same sensibilities that we get for the WMB3 on the intraday translate to the swing trade time frames. Hint, yes, they do. The 3-day is a really powerful way to get a smooth performance. It's not as jumpy as the daily, and it's faster than the weekly, and so you get a very clear indication here of that Kata 2, and now the Kata 2 lets you get in here around 440, even better, and then a PSAR flip in here at 435, and now there was a strong move down to 405. It's about an 8% trading opportunity just by following the 3-day. The daily, we can see I've cleaned up some of this to make it a little bit easier to see price. I want to show you the 5-day range, which is what we're using to compute the sniper volatility. Then there's the 10-day range. Then there's the 30-day range out here. And then you can't see it, but the 150-day range is also in there. And what's important to note about the S&P here is that, you know, the daily range from today is pushing right at the collapsing dragon at the belly of the RL10, That little price right there at 405 is simultaneously the 5-day low, 10-day low, 30-day low, and 150-day low, which, if it gets breached, warns us to look out below. Uh, the blended monthly rebalancing portfolios, even the best blends, were getting smashed this week. Not as bad as some of the other ones, like real estate is getting murdered, as is treasuries. Holy smokes, that's your risk-free rate of return right there. Only a handful of things held up. Diamonds, the S&P itself, and Japan. Everything else pretty much taken out and slaughtered. When you get into the broader portfolios and more narrowly defined sectors, now you're starting to see why that is advantageous as you take a look at defensive plays like utilities and the energy commodity area, which is benefiting from politics and economics. Consumer staples holding up fairly well as one defensive play in the sectors. The ETF 32, which adds even more fidelity to the energy sector, gives you that kind of exposure. So even looking at simple 30 ETFs gives you the ability to really differentiate between the best and the worst. It's the difference between having 7% and this week and 5% this month versus -6 and -11, or worse, -17% in the very weak PBW, which has come all the way back to the original sell-off. In the Dow 30, Chevron just crushing it. IBM surprisingly strong. And then you got a few others that are in their own little niches and doing well. 3M, Walgreen, Verizon, JP Morgan in the financials. Let's see. In the ETF regional report, 100% of the 10 big indexes are below their 4-month moving average, so they're not ownable. We are in bearish volatile. The S&P is still a little better than the EFA. Inside the U.S., the mid caps are better than the large caps, are better than the small caps, and tech is bringing up the rear, just getting murdered. Inside the XL series, the only thing that's close to working is energy, and utilities kind of in a second place, and I would say staples in third place right there. But everything else getting slaughtered. In the broad asset classes, the blended commodities very strong, oil itself very strong, gold well above average, and you can see compared to the S&P, compared to treasuries and these other asset classes, just not getting it done. So it doesn't take an awful lot of individual trading components to give you some real insights into what's going on in the world market model. You see the U.S. mostly underwater, only energy doing well in the sectors, oil and commodities doing very well up in here. Private equity and hedge funds are just getting slaughtered. That's what leverage will do to you. This is mostly energy, metals and mining. No surprises there. The big volatile and liquid ETFs for good trading purposes remains the Qs at 3.7, semis at 4.3. We're looking at the ATR percentage here. And the ones in green are exceptionally volatile as well as all being liquid. So semis are worth trading. Consumer discretionary is 4% volatility. S&P Biotech's 5.5%. That's how volatile things have been. Brazil and oil exploration above 4, and market vectors gold miners bringing up the rear at 3.8. Shifting to the daily, obviously no channeling overreactions because we're well under the 200-day moving average. This is an example of how market conditions can be baked into the rule sets of certain systems so that you can't even go long on those because they require, at Rule 1, a close greater than the 200-day moving average. And for our purposes, that's enough of a market filter to keep you from going long on these kinds of swing trades. You notice the prevalence of energy, Chevron and XLE up in here. Alcoa, Boeing, Tesla getting slaughtered. Lots of auto framers setting up well. There was a surprising number of dojis today. Going into Friday, you would have thought that the range would have been greater, but auto framers in the ETFs also setting up well. A handful of dojis. See the strength in oil exploration, oil itself, and the energy sector, and very little else to commend it. You can see how bad clean energy is. Nobody cares about clean energy when you can't even heat your home. It's just not mature enough to do anything with it. The auto framer, again, this is sorted by the reward to risk on a test of the 10-day high. The ones that are near the top not only make interesting rebound candidates, but if they fail through the previous day's low, they're already so far below the 10-day high that it becomes a great candidate for intraday shorting, one-day shorting targets. Daily squeezes, only Alcoa is better than 2-to-1, so its lack of volatility makes it exceptional and makes it, as always, an interesting candidate for trading on Monday. The Godzilla setup here. Let me get the boy. There he is. So again, the Godzilla is my favorite setup of the new Sniper series. In Godzilla, we're looking for things that are in the bottom 10% of their long-term look back, in the bottom 10% of their 30-day look back. We're interested really in any extreme condition here on the tactical, but the fact that if things are that beaten down on the long term and midterm, and then we're looking for exceptionally strong Z-scores for excessive volatility. And right there is about 20 or 30 symbols that meet all those criteria and are at least one standard deviation, almost two standard deviations greater than their normal 5-day volatility. And then a bunch of these are better than 4. So you've got some amazing volatility just begging to be traded from these critical conditions. So essentially, the Godzilla looks at things that are in that bottom 10% on the strategic and the operational. It's happy to take it from either the very top or the very bottom, as long as it is very volatile. And that's what gives you, Godzilla, King of the Monsters, for an amazing setup. And these are all the ones that meet that criteria out of the S&P 500. The fireworks and the Humpty Dumpty are what you get when you are finding things that are in the top 10% of their weekly and daily. The fireworks they're in their top 10% and they're very volatile. And then the Humpty Dumpty would be ones that are in their top 10% and we'd like to see those at the low end of their midterm, but basically nothing fits into the Humpty Dumpty that is at the top and the bottom. So these are essentially all the fireworks. And what that means is we would not be surprised to see, with their explosive volatility, for additional follow-through if there was more work ahead of them. So you see ConocoPhillips. I mean, it does not get any better than that. That's a breakout to the 150-day, 30-day, and 10-day high with a volatility of 2 3/4 standard deviations above average. There's Devon Energy. Even Campbell's Soup is kind of cool. And then you got to respect the defensive play that's in there. This is, I think, Occidental Petroleum. So you can see that the energy companies are non-surprisingly way at the top. The fence sitters, on the other hand, are ones that are in their very quiet mode in terms of volatility. So we're looking for anything, in the zero range here. And then we're also looking for things that are between zero point 0.4 and zero point 0.6 on their index and very quiet. Now, I've included the excessive z-scores as well because it may be that they just started a one-day move now while they're still sitting on the fence and the fall has started. So the fence sitters turn out to be very interesting straddle plays for options players. And if you don't have a directional bias, that's an interesting way to play from a quiet condition. The sniper and the auto framer, I have this sorted by the percent change daily. So what I really like to do in a bear market is just look at the extreme conditions, the ones that are making money, and then the ones that just got murdered, and looking for continuation patterns. And then this lets me check for the standard reward to risk in this column, the range compression, the squeeze play risk here. And then, as I talked about the other night, I've included just for my own reference, because I use this chart quite a bit for my own setups, is the range stat, which is the maximum reasonable intraday move, divided by 10, and that turns out to be a pretty good start point for estimating your minimum manageable risk box. That's something that came out of a Creativity 202 collaboration last weekend too, by the way. And then you can see where the S&P fits inside of our standard set of tradables. And then the column explanations, well, that would be the column explanations for you right there. Winter dominating the four seasons, no surprise there. Merck and ExxonMobil bucking the trend. And again, no surprise. Energy, the energy complex, the only thing that's any good. That's also tradable. Gloom, despair, and agony, as they would say on Hee-Haw. And we are at 2 sigma in terms of the downward slope of the RL30. That's extreme. That's as bad as it's been in the last 180 days. And it's the second worst in the last 10 years. That's how bad the last 30 days have been. Enough said on that. All right, we'll take a quick look at this one. So this is a visual box technique. This one happens to be in Brazil. And in the usual way, I take a look. Here's that this is a 25 cents standard wrist box in Brazil, and I notice how well it captures the non-directional move that finished up the day yesterday, and then in this last little bit of quantum trading, that little box, it moved up a square. So this blue vertical line represents the opening of trading the next morning, and it opens right where it closed. It moves a visual box trading move off the top. That's like an MMRB, and this market is in bearish volatile, and Brazil has sucked. So that to me is an automatic short, because I know that if I come back over here and I see this line, get that. If this thing collapses, look out below. So I'm front running that by a nickel, but I'm already in, so let's just see what happens. Any questions on that, on the basic concept of visual box trading? It feels very much like standard Kata 2 or Sniper. We're not going to lose any money on that trade. We might have decided to take an extra position there. That I didn't, but you could reasonably have decided to do that. Reasonable exit, because I look at as I'm looking at the MACD, the collapse has begun in the orderly sell-off, and then this is where it moves back into the spring. There was enough sideways chop in here that the season went from winter into spring. So that feels like a good place to just make, let's see, what is that? Let's see how much that is. So that's about 1, 2. That's about 2R on the first trade, check or hold. You guys see that? It gives us a standard kind of SSC. There's your minimum manageable risk box off the bottom, and you'll notice that the seasonality went from spring into summer. That's kind of a low risk idea right there, and you just make that your risk box. And how soon now can I get my risk from here up to about here, so I can get my risk out of there. Probably like right about now, like right about in here. I could live with that, and I'd be strongly already considering, hey, why not get paid? Why not get paid? End up getting paid at the same level anyway. This was failure to follow through, so the second time it comes down and tests. That's more than enough, and that's about. Let's see what that is. That's maybe 0.8. So we're at about 2.8 for the day. Failure to fail further makes a kata 2, because now all this is in play, right? And then that creates the kata 2 feel, and it's testing this upper limit, right? This feels like it feels if it can break north of that, maybe it could come up to here. Worth a shot, kata 2 in style. One of the things that happens is when you get very structured in your trading, the way Griff is doing that you end up seeing those patterns habitually, even if you don't have all the little technical indicators. When you've looked at 10,000 charts like that and you get habituated to the kata 2, it becomes very easy to see them when you go to this lean and efficient screen setup. It's worth investing the time in calibrating your eyeballs and your feelings in that way. So now we're getting real close to that next little chunk, right? So if this was 1.5, I should be stalking an X. I should not let this go back below, say this, right? I should not. Oops. Let me draw that better. I should not let that go below this line right now, because what I want to do is make sure that I lock in an R, correct? So I can be stalking on this line for an exit, and I have, therefore, about this much wiggle room to deal with. Now, you could take that trade, you could take the exit now and lock in that extra little green dot, but if this breaks above that blue line, I might be interested now in playing the breakout from this resistance level. So that's why I'm willing now to risk that the gains of that green box. So in my mind, what I should have been doing was I should have just added a position right there, because why not? If it falls back through that red line, I'm out, so I've lost a sliver. But if it breaks through that blue line to the upside, I've gained this extra blue box right here. that extra blue box is now mine. Instead of waiting for confirmation to break out, I can identify this little critical state in here, and I call that buying it on the button. But I didn't do that. Wish I could follow my own advice. But I did play the confirmation of the breakout, and then moved my stop up to that thin red line so that I'm only taking about half a risk. So let's take so when I put that, let me get this one out of the way because I didn't take that trade. So now when I get that breakout, the full risk box would be this one, but because I have two positions on, I don't want to give back a full unit of risk on two positions because the second position hasn't earned anything yet. Well, now it has. But back here when I put it on, it hadn't. And it was at a risky state. So that's why I only go with half the risk. So if that red line, the thin red line gets hit, I end up losing a total of 1R, or half an R on two positions. So I'm going to be stricter when I have two positions on than when I have one position on because of money. And now when that thing rolls over, you know, I've got my stop up here to no lose plus dinner for two when it peaks out up here. And I just say, you know what, that was enough, and just be done with it. So that works out to about 5R for that initial run with visual box trading on a standard trading technique on minute bars. And that was that. I just wanted to share this one with you. This is what happens when you use like an alternate lens. And what I've done is I've gone in and I made the price line, as you can see in here, a very, very, very thin gray. And what I'm really doing is checking the relationship between the RL10 in the blue and the excuse me, the RL270 fair value, and also the the RL90 is this green line. So let me put that's their RL270, and then I need where's our black line? There he is. If I made that black. So one of the things that I like to do at some point, your black line was here, the fair value was here, and your blue line was up right around in here. So that's a pretty tight array. Whoops. That should be blue. Yeah. That's a pretty tight array of those four regression lines, right? This is a daily price bar. It gets even tighter when we get up into something like this. This is almost looking. There's a super pinch for you right there, right at the peak of everything. Here's the RL10, and then here's your RL30. I mean, that doesn't get any super pinchier than that. And one of the things that you are looking for in a super pinch is the next leg. Is the next leg just going to be pure sideways forever? Has it found its perfectly balanced price and never going to deviate? Or could this thing lead to an amazing uptick, or could it lead to an amazing move to the downside? B, moving to the downside. Right? So that's what happens in a super pinch. When everything gets together and you've reduced volatility and all the regression lines agree, the very first thing that must happen is that a trader with this little RL10 is the first guy to break along with price. And then shortly thereafter, the RL30 begins to follow, right? The black line. And then shortly thereafter, the RL90 begins to roll over and leave the station. And then finally, the very last guy of all, the RL270, has to leave. And he is the slowest one to adapt because there's 270 data points. That's the big daddy rabbit. So once things break out of that super pinch, you notice how the RL10 went from the peak through a collapsing dragon, another collapsing dragon, all the way down to the bottom of that price stack. And in that moment, there was a massive disconnect, a disagreement between the trader's fair price and the long-term buy and holder's fair price. That's the difference of opinion between the shortest short-term trader, the RL10, and the longest long-term trader, the RL270. And in that moment is that difference of opinion creates an opportunity for this kind of trade. And what you get is that rebound that now crosses the RL30, leaves the dragon, gets almost up to the midpoint. Here the RL30 is still down here. Now the RL10 has moved all the way up here in a hurry. The RL90 has drifted down this far as sort of a intermediate target, if you will. And the RL270 is barely budged, but it has rolled over. Like the slope used to be looking like this, but now the slope looks like that. And this is what that first deviation in price expectation looks like, that failure to follow through. This big sell-off was enough to bring the RL270 down from its projected price level all the way down into here. Well, this move in the RL10 was nice, but that's as far as it could go. And then it rejects, and now you have a collapsing dragon a couple times through here, and then it comes down once more. So take a look at how far the RL10 is now from the RL270. Oh, it's the same price. So that is that is how far the traders can take the price away from the long-term buy and hold. By that time, the RL30 is there. The RL90 has moved halfway between the RL270 and the RL10. And then you get a slight rebound, but then a collapse again. So there's one more murderous leg down. And now the RL10 and the RL30 are both way down here at the bottom. And the RL90 is about in desperate condition. And only the RL270 is resisting the fight. And you get another nice extreme opportunity from an extreme stretch away from the 270. And then a rebound that takes it almost back to the fair value. That's how strong that move was. So what can you do with that information? Well, you can do something like this. You can take your standard risk box and say, I'm going to hang it from the lowest low, and if that thing moves out of that price range, I can get a low risk entry and use my manageable risk box and then just trail that. And now you get about a 4-to-1 R multiple. So that's one of the reasons you want to get in the habit of using that kind of visual box trading technique, because you can rapidly frame trades. So now by this time, we have the RL30 still stuck down here. It has only begun to roll up. The RL90 is down there with him, and the 10 and the 270 have temporarily joined forces. But he couldn't hold. So the traders moved to the next one. And now there's two big legs down. And notice how strong that move is away from the 270. It's the same level of stretch. Now the last two times that it fell that far, there was a strong rebound that took it most of the way back to the RL270. So what does that move look like? Well, that move could be something like this. And how long did it take to make those moves? It took about 2 weeks to make that move all the way back to the top. So if the law of symmetry applies, we wouldn't be surprised then to see something like this kind of move unfold over the next 10 days, is a return back to 445, which would be almost a 10% recovery. So you can actually use these moving regression lines, the 10, the 30, the 90, and the 270, to begin to estimate the size of statistically reasonable moves. And I like the comparing the distance from the RL10, the fast member of the fast pair, to the 270, the slow member of the slow pair. And the 90 gives me that intermediate target as I try to gauge how much of the move is left. So I just wanted to share that technique with you. Let's take a quick look at there were a handful of traders posting today. Just for Nick, here's that's my RLCO coffee mug for you right there. That's the pattern we want. That's your P1 and then the crossing of the dragon. How to stay focused. All right, let's take a look now. Let's see, draw. All right, so here's Wojcik. Collapsing dragon gets paid. This one didn't work, and it covered. This should then lead you to a long, which will get paid huge. Now you got two big chunks of that, which is nice, but I think there was more to it. You got to start looking at that as, especially when it crosses the VWAP, to get in a little earlier. Got paid, got paid, got paid. This is one right in here. I think you'll discover that that there was a signal in there that was missed. So here is here's, I think, oops. Yeah, here's your oversold. Here is your uptick. So you should be long here, which you were. You took a quick loss. That's good. This reversal, somewhere in here, this recovery allows you to get long again, because this was failure to fail, and this gives you like a Kata 2 sensibility. You should be looking to get long right in that space, because you're getting this down, up, and it failed to fail here. You took a quick exit right in here, but it didn't fail. It reversed instead. So when that takes this out, you can take that and get long, and that's a Kata 2. That would let you capture this, which would have been one of the better moves of the day. Let's see what else we got here. Yep, got paid, got paid. Two quick losses, got paid. And this was a break-even day. But see, I think there's, this one that you missed here and the one that you missed here could have made this probably about a 4 for the day. We got a little tight. We got a little better as the day went on. Nick, the RL lines are on TC2000. There's a video in the Foundations course how we set up our charts, and you can follow along with that. Straightforward. You can also, when you have TC2000, just ask me for that sniper framework that I used on the the simplified version. That has, you can just import that and just use my setup. Save you a bunch of time. So Nick had a pretty good week, 7R for the week. He's up around trades 800 to 850 right now. You're about getting ready for a write-up on your reflective learning journal, and especially with respect to this to this technique. It feels to me like you're starting to internalize it and get it. So I'd like to see you follow that same model that Phil and Tim used to capture your lessons learned in your reflective learning journal about this technique with WMB3. It feels like it's fitting you pretty well. I mean, you're staying with it and your numbers are getting better. That's my spider sense anyway. All right, here's Tim's work for the day. And he brings home 5.5 for the day. Starts trading here. There was an opportunity right here where across the Bollinger Band mean and the VWAP to have gotten started. Then this one, so that feels a little late. We might have been able to capture that extra piece, and then that would have paid off pretty nice. This is a great re-entry and a great capture and an even better stop and reverse and a perfect capture, perfect capture, perfect capture. This one might have been a little slow, but I like that you got through the dragon and still got paid. A couple quick losses. This is the one that I think we would have wanted to get when it breaks through the PSAR dots. So I think we could be short here instead of here, and that would give you that extra piece. But that's a pretty good exit. Got paid really well. Got paid really well. That's pretty good efficiency. 5.5 for the day. I think that's. I think that was pretty good. Pretty good work, especially on a busy day with lots of meetings and other distractors. You terrify me at the thought of you being focused. I'm glad you're on our team, not on the other side of the trade. The collapsing dragon only for today. There was a couple good moves that got paid. We'll see that on the SSC, and then this was mostly just the grind. Very quick losses, not much to write home about, and you got the moves that were available, and so know when to fold them. That's pretty good work right there. Being positive even with that many grinders. So attention to detail, it all adds up. All right, that's everything we got for the day. I want to get this published and posted, and more to follow. I'll have something to say about getting an early start on the Creativity 202, Phil, and I'll put something out this weekend. I have some time tomorrow afternoon. Yeah, that's everything I got for you. You guys take good care. We'll get this posted here shortly. Thanks.